Hello, today I'm speaking to CEO of Javelin Capital Markets, James Cawley, on what implications the new swap execution facility regulations will have on the markets, but also if such regulations will have any impact whatsoever on financial stability and transparency. Well, James joins me now in New York. Thank you for joining me today, James. First of all, what exactly are these new regulations from the US Commodity Futures Trading Commission? And what will they mean for the trading community?
So, really resulting from Dodd-Frank, the Dodd-Frank Act in the United States that was passed a few years ago, three of the tenets were one, in Title VII required swaps to be cleared, swaps to be reported, and then also swaps to be traded on either exchanges or a new entity called a SEF, a Swap Execution Facility. So what you're seeing today is those rules have now been drafted and have gone into effect. They were drafted by the CFTC in May. They take effect today, or at least partially come into effect today.
There has been some criticism that the industry is just not ready to make such a transition and adopt this new type of trading. You're one of the first companies to have adapted yourself to this. In some cases, the CFTC has written to some companies who operate SEFs, telling them they can delay adopting certain rules. It all sounds a bit of a mess, doesn't it?
Well, yes. I mean, you're talking about a seismic shift in the industry in terms of how swaps get traded. At one point they were done in an unregulated basis, and now they have to be traded on regulated exchanges or SEF. So, as in any situation in any industry, you're always going to get growing pains, and we're certainly seeing those today. There was some confusion with some of the rules as to whether or not they apply to certain types of trading methodologies, whether they apply to certain venues, whether they apply geographically to, do they apply just into the United States, do they apply outside the United States? So some of those questions have been answered, some of them have not been answered, but as with anything, there's always going to be growing pains.
There's also some concern over how much of the rest of the trading world could be affected by such regulations in the US, with authorities in Europe already asking the CFTC to delay the new rules in case they cause problems for foreign trading platforms who are doing business with banks in the US. Just how likely is it that other overseas trading platforms will be affected by these new regulations?
It's hard to tell. Certainly the rules as they govern U.S. trading and I believe U.S. persons. The definition of a U.S. person obviously is, does it include branches overseas? Does it include subsidiaries overseas? Does it include foreign entities overseas? To what extent is there nexus, whereby they're brought in under the rules? But, look, the CFTC, their job is to protect the U.S. economy and the U.S. taxpayer, and to move forward on regulations that they've been given, the mandate to execute on. And we would only hope that European regulators, after numerous delays, would be able to step up and actually do what they said that they were going to do in terms of getting their regulations complete. And so on one side you've got the U.S. moving forward, and on the other you've got Europe delaying and kicking rules into next year and the year after that.
Finally, James, are you now expecting to see liquidity moving to London as a result of these new regulations? And how likely is it a two-tiered market could be formed?
I would say that makes great press and, stories, apocalyptic views of the market bifurcating and having two-tiered or on U.S. and off U.S. I would say, well, you have to look at where the goal of these regulations in terms of trading and what the long-term aspirations are, and that is these rules are designed to bring trading into transparent venues, to increase competition amongst dealers, to give customers lower transaction costs, and to enhance liquidity. And I would say that there is already competition within the SEF space. They're not just one or two exchanges competing. I think at last look within the interest rate swap environment that we focus in currently, there's 6 or 7 SEFs. There might even be more. And that can only mean good things for the end user: greater transparency, greater choice of execution venue, greater modes of differing modes of execution, whether it be anonymous or disclosed or request for quote or central limit order books. And ultimately, this gives an opportunity for more people to compete. There's many dealers out there and many customers out there, and having these venues match buyers and sellers and having more venues do that, I think in the long run will increase competition and lower friction in the marketplace. And ultimately, the beneficiaries of that are going to be the customers as a whole, but also, systemically, you'll have a safer, more transparent marketplace. In the short term, sure, as firms and buy side and sell side try to get their arms around these rules, people are taking differing views. We've heard stories of plane loads of interdealer brokers flying to London to stay outside of the jurisdiction. Whether that's true or not, I would say that these are short-term speed bumps that people are working, working pretty diligently, I should say, both SEFs, interdealer brokers, and buy-side and sell-side alike to overcome, so they can get into sort of a more smooth transition.
Okay, that's all we've got time for today. Thank you for joining us. I'm sure our viewers will be keeping a close eye on these regulations, but in the meantime, to check out all our other topics, click back to our homepage at Dukascopy TV. But for now, goodbye.